Welcome to Early Edge Club. Before we deep dive, we are opening Early Edge Club to a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. You will be surrounded by thoughtful, like-minded investors from diverse backgrounds, and we are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
Macfos Limited is an e-commerce platform which does marketing of a broad range of electronic components. Its product portfolio includes robotic parts, drone parts, e-bike parts, IoT and wireless systems, 3D printers, sensors, motors, and various other mechanical and electronic components. The company came up with its IPO in 2023. It was an entire OFS issue of 23.75 crores, and they also did a 25 crore QIP in 2024. The QIP was participated in by Sage One, which is a very famous investment corporation. I'll give them a 3 here. Director and promoter track record. Mr. Atul Dumre is the managing director and chairman of the company. Then Mr. Binod is the full-time director and CFO. And Mr. Nilesh is the full-time director of the company. The total promoter holdings of these three people sums up to 69.12%. They don't have any negative track record, so I give them a 5 here. Regarding related party transactions, there had been some minor loan transactions, but none of them exceed more than 30 lakhs, so it's nothing very significant, so I give them a 5 here. So board independence is significant. There are 50% independent directors. There is no family on board. These three executive directors are business partners. Regarding salary, the MD and the whole-time directors, all three of them draw the similar salary. It was 24 lakhs in last 2023 and it came up to 30 lakhs in 2024. It's a significantly less percentage of sales, 0.24 and 0.25. So that's nothing significant. So I give them a 5 here. Executive director resigned in 2022. It was a crucial exit. The executive director was with them since the beginning of the company. We don't know yet for what reason he exactly exited, but there was an exit and there hasn't been any other resignations in the company. So I give them a 5 here. But this is something that needs to be noted. And auditor has their tenure till 2029. They're appointed for a second term. So I give them a 5 here. Regarding auditor opinion, it's unmodified for the past 3 years. CRISIL gave them a triple B rating for their long-term financial banking standing. So I give them a 5 here. Regarding regulatory issue, nothing could be found against them. So I give them a 5 here. Regarding investor communication and disclosures, yes, they do their presentation and con calls and results quarterly. So I give them a 5 here. Regarding business concentration, in the last 2 years, they have served around 3,10,000 orders in 2024 and 3,96,000 in 2025, out of which the number of customers they served were 1,04,000 and 1,82,000. Now, this increase from basically they have added a lot of small ticket size SKUs in their inventory. So you can see that the number of orders and the number of customers has increased in very similar proportions because of that. Regarding their competition, they have international competition from majorly four big players, which the management mentioned in their con call, which is Arrow, Farnell, and Mauser. Mauser is already in India in partnership with another firm, and DigiKey is planning its entry into India. There was a Value Picker article which mentioned that it is partnering with an Indian company recently. Like news is as of 2 weeks old. Regarding the return and replacement statistics, they returned around 58.19 lakhs of inventory came back to them in 2025, which is very small as compared to their 250 crore revenue. So that's good. There are 50,000 plus SKUs, 150 plus brands, and 210 plus vendor tie-ups in India and abroad. Regarding their revenue breakup, 22.54% came from development boards, 16% came from drone parts, batteries, chargers, and accessories contributed around 11%, electronic modules and displays contributed 10%, and motors, drivers, pumps, actuators, and sensors together they contributed around 15% here. So that's good. Now, regarding their customer engagement, which is a very crucial aspect for an e-commerce platform, their average monthly website and app visitor numbers have increased, but it still stays a bit lower than their half two of fiscal year 2025. So their average is higher as compared to last year, but yeah, their half two was much better than the half one than last year, and average order value has also increased a bit as compared to last year. Now in the management world, a lot of analysts ask them that since they've added a lot of small ticket size SKUs in their business, so will their average order value decrease? The management was a bit ambiguous about it. They said it might increase, it might not increase or decrease maybe. This is because most of the customers who buy from them buy a lot of products, so average so they're already buying a lot of things from them. When these new small ticket size items coming, they add it to their already existing high order value cart. So this may result in increase, but it can happen other way also. They might only buy the small SKU products and it would decrease the average order value. So that's what management said. Total SKUs, as you can see, it increased up to 71,054 from 18,349, so around 50,000, small ticket size SKUs were added. Regarding the revenue growth versus receivables, revenue growth has been very good in the past 4 5 years, and receivables growth has been very less as compared to revenue growth. It's increasing rapidly, but it's much lesser as compared to revenue growth. Receivables as a percentage of revenue is just 2.2%, which is a very good signal. So I give them a 5 here. OCF as a percentage of EBITDA is minus 91%, which looks very bad, and it happened as a result of very high inventory, and they have given a lot of loans and advances to others in their current assets. So this is something that needs to be monitored closely. That to whom they have given those loans and advances. The loans and advances sums up to around 27 crores. So that's a big amount. So that's why it drained their OCA by EBITDA. On an average, also OCA by EBITDA is not that great. So I give them a 3 here. Inventory turnover ratio is 5 and inventory days is 70. DSO is very less, 7. That's nice. And the management mentioned that out of the total inventory as on March 2025, only 2.64% inventory is very slow moving, which has improved since last year, which was 3.68%. Now, they classify slow moving inventory as those inventory which have gone unsold for more than 9 months. And in there, they don't have any product which has gone obsolete or perished over the because of high inventory period. So all of them are non-perishable items. Regarding cash conversion cycle, DSO has been 7 as we noted. Inventory days is 70, but it has been declining since the past 3 years. Payable days is good. It has decreased a bit, but however, the cash conversion cycle remains close to 61 days, which is around 2 months. So that's good. So give them a 5 here. CapEx is a percentage of revenue is just 1.8%. They are not doing some heavy CapEx, but fixed asset turnover has improved. Asset turnover has improved in the past 3 years, and return on invested capital is quite high. So I gave them a 5 here. Yeah, so debt to equity ratio is 0.3, which is very good, and interest coverage is good. So give them a 5 here. Regarding the quick ratio, I rated it a bit conservatively. Their quick ratio is 0.4, which looks too less. They are operating with they have cash balances of around 50 lakhs, which seems very low for a company doing 250 crores in revenue. A majority part of their no current ratio is inventory, as you can see, or 3 of almost 2.1x difference. So give them a 3 here. And return on equity, return on capital employed, and return on assets seems really good. Return on asset has decreased over the past 4 years, but it's still high. So I give them a 5 here. Now they have posted a very good revenue growth, which we already mentioned. PAT growth is also very good. But yeah, they faced a margin dip. As we can see, EBITDA margin decreased from 14 to 13 and now 11. And also PAT margins decreased from 11 to now 7. So that's a huge dip. Now the management says that the margin dip has been there primarily due to increased corporate sales, because to crack a high volume deal, they often cut down on 1%, 2% margin to get the deal through. Now, some of the key takeaways are there. Okay, first we'll come to the business model basically. Yeah. So they have two businesses. One is their e-commerce platform and one is their own private label. Their website is robu.in, and Robu 1.0 is their existing electronic distribution business, the e-com platform. And here they provide new technical products at affordable prices and providing other services. So this is the Robu 1, their initial core business model. In Robu 2, they developed their private label. These are the four brands which they own, and these are SmartFlex reflects the electronic products. EasyMake reflects the mechanical products. Simplify VCI reflects the drawn products, and Pro Range reflects the OEM products. So they have been rapidly developing their own SKU over time. Now these are their customers. They are partnered with one of like some of the biggest brands in the country. Now one thing to note is that one of the analysts in the con call asks them that whether the orders they get from these big clients, whether they are repeat orders or not. So what the management mentioned is that the product category is not repeated, but the order frequency is repeated. Suppose Tata Advanced System is setting up a lab, so it buys a couple of equipments from them, and then again for replacing those equipments or upgrading them, they buy other set of equipments. So the orders come in, but the products usually don't get repeated. That's what the management said. They've got a 35,000 square feet dedicated warehouse for storing, and there were 200 plus staff. So Robu 1 is their existing business, which I mentioned, and Robu 2 is focused on creating and developing more own brands and products. They invested 40 lakhs in it in 2025 in its R&D, and are planning to expanding their current distribution business. So they're primarily focused on electronics, mechanical, drone, and OEM products. The management feels that there is consistent demand across product lines and through boosted growth, and optimism continues for future market traction. They've added around 40,000 new small low cost SKUs, enhancing breadth and diverging product variety. And their focus areas in the future includes supply chain acceleration, B2B expansion, ERP-led efficiency, and scalable IT systems. In fiscal year 2025, they launched 186 new products under Robu 2.0 from majorly two categories, which is development goods and modules and drone parts. Some of the risk they face is that they have high exposure to intense competition from other e-commerce brands, and the company is dependent on external vendors for sourcing the product requirements, and also they're dependent on changing and evolving regulatory permits and approvals. Since it's a small company, any major change or in any major compliance requirements can affect their margins and revenues. Also, they have a product category concentration, as we had mentioned earlier. A significant percentage of the revenue comes from all these top five or six products, and the rest are just a small percentage. So, this is a product category concentration, if not client concentration. And overall, their promoter score comes up to 48, which is very good. It would have been a 50 if the fundraise was a bit for a better cause, maybe. And regarding their financial health, it's 46 out of 50. So the final scores comes up to 94 out of 100, which looks really good. The only concern regarding is there that they might face some sort of cash bid insolvency if they don't maintain enough liquidity. Also, their operating cash flows by EBITDA is also quite less.
Let's quickly run into where they currently stand. Let me present my screen. A few things which they said during the con call. I was listening to their con call as well because I found the company very interesting. Good to know that the management is clean. I have not run through that, and that's why we are running through that.
Yeah.
Currently, they are.
But if you see the call, the management is very uncertain about a lot of things regarding their future growth, revenue. They're like mostly they are trying to avoid to state any quantifiable things. Like they're not cannot be sure of how much revenue they would make, and the management give a reason that they cannot predict that because last year a lot of their orders were from non-repetitive orders, which might not happen this year. Also regarding their margins, they have said that the margins there was a dip due to corporate sales, but they are trying to improve, but they cannot guarantee any of that. Someone asked that what would be their market share regarding so they said that the market is very much unorganized, so they cannot give an accurate figure. They just mentioned four competitors. So that way, the management is not very convincing in terms of numbers. They're just saying that they'll grow well.
But market share, because they are in multiple products and it's very unorganized, maybe that has hurt their take. I found it was okay. It's good to have a market share idea, but if they don't have, it means the market is extremely unorganized, and you have to understand the current purchase history of these organizations, how they are doing it, to understand a bit more into the company's future prospect and how they can eat into or move from an unorganized to organized sector. So
Yeah.
that's important. And second, regarding the future prospects, they are not able to give guidance on Roku 2 because they are trying manufacturing of certain products which they could supply to these third manufacturing, which are their own labeled products. So I think it is very new for them. So they are also not very sure as to what guidance they can give on that. But if they are able to identify high volume niche product with good margins, then that could lead to good re-rating.
Yeah, market cap is very less, so it has high growth potential
Yeah.
if the company does things right.
So it is currently at 40 PE, like around H1 it shot up. If someone would have listened to their con call, they would have understand this 86 crore ka revenue in in 2024 September is because of a large order they got. They have been consistently saying that order is not repeatable, but the, proof of market traction is there, and once they're empaneled or a supplier or a company starts buying from them, they continue buying from them, so that's a good thing. Regarding the current price and valuation, I think it's a bit expensive, pricey. This best case number would not be this case because this number is calculated based on historical growth rate. I, 444 would not, I don't think, until and unless they get some large non-repeat orders, I don't think this number would be repeatable. So to understand if fair value, I would cut the margins to 7.5. They have been doing, the margins have been coming down, so that is one thing which I don't find comfort, and I would be giving them a 30 PE. So looks like almost correctly valued at the current price, little room for re-rating according to me. If you give a 40 P, which is a current P, then there is some upside left. But overall, looks like on a 1 year forward basis, it is valued appropriately. So let's see how the management delivers. And if you take a longer term view, then if you do a reverse DCF, I think they would do only 25 profit before tax in the earnings. So let's give that. And since microcap we are taking higher risk, I would give a 20. Our minimum return expectation should be 20%, and taking a 5 years view and a 15 multiple, the company has to grow at 28% approximately. Is it doable? I think it should be doable, but few things are to look into. As you said, the competition is entering the Indian market as well. Maybe a bit of a correction would be a good point to enter. I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20 factor scorecard, Feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye-bye.